Thanks everyone for joining us today. It continues to be a rough year to date in financial markets, whether that's in the fixed income side, whether that's on the equity side, or really a smattering of assets outside of really just the strength in the US dollar, as well as even some of the strength that we've seen year to date in the commodity complex. Although we have seen some rolling over of the commodity complex as of late, really just exacerbated by a lot of volatility. I thought it made sense to really review the macro landscape of what got us here and what's going to be the driver of financial market performance over the second half of 2022. So with that, let me start with what's going on across the globe, and we'll do it with a review of world GDP. And so there's a lot of talk about a global contraction and potentially a global recession, and a lot of that's been magnified upon the US market, which I'll cover in a minute. But looking across the globe, what we've seen is prior to the pandemic, that world GDP tend to vacillate somewhere between 3 to 4% on a real basis. And so why I point this out is that has been the trend line growth really since the global financial crisis. Obviously, we saw the decimation that took place in 2020 with the global pandemic, and we saw the recovery that came back in 2021. And if you kind of compound those 2 years together and put them together, you got a cumulative growth between those two areas of about 2%, or if you call it on an annualized basis, roughly 1%. And so obviously that's below trend. But what we see here, even with the reduction of what 2022 was supposed to be, something that delivered in roughly the 4.5% range, or was economists' estimates really at the end of the first quarter. Now what we've seen is that they've really gravitated back into the low end of that trading range, which we've been in really since the global financial crisis. And so at this stage, again, it's a little early to tell. We'll get GDP in the US. We're one of the early reporters when it comes to second quarter GDP. It'll come out towards the very end of the month, and we'll see what that portends as well. But when you look at 2022 and 2023, what you find here is that we're roughly going back to these trends that we saw. So even the decimation that took place in the pandemic, we had a little bit of recovery on the other side. We overshot to the upside, and we seem to be settling in at or around trend line. And if you look at the economic data and you break it down by region, and I want to remind everyone this time series, what it does is it takes for each region, it amalgamates a bunch of economic statistics and data points and compares them contemporaneously to what has been that experience on average of those data points over the last 12 months. And so when you have a positive number, that means the economic data is outperforming on average where we were over the last 12 months. And when it's negative, it is underperforming where that's been. And you can see here that taking a look at these time series, that obviously everyone overshot significantly relative to those depressed levels from the pandemic, really distorted the scales here. But ultimately, what you see is that all of the economic data right now is slowing. So irrespective of the region, whether you look across the entire globe, you break it down by the key geographic and GDP regions, what we see here is that every single region is underperforming on economic data where it was 12 months ago. So that's kind of the bad news. Remember, that's a relative statistic. But when you start to look at some of the data, what you find is that there's still parts of the globe that look somewhat expansionary. And so what I have on the screen here, it's a wall of numbers. But what you find here is that the manufacturing surveys still look to be somewhat expansionary. Remember, the reference point is 50 when looking at survey data. What that means is that when we look at a number greater than 50, it says on average that more respondents are expansionary than contractionary. They're what we call a diffusion series. So the magnitude really just talks about the number of respondents that are responding in this positive expansionary type of manner. What you find is that if you look at the bottom panel, you notice that there's some pinkish or reddish areas, and that is the contractionary part right now. So when you look at the manufacturing expansion, it still is taking place within the developed market world, but it is somewhat contractionary. At least on average, these respondents seem to be more contractionary than expanding their manufacturing plans at this juncture. The good news on that, if you were to take this and look at the emerging market side, you'll see that the one that it has went into expansionary territory as of late is China. And we all know that China is the big behemoth when it comes to driving the emerging market space as well. So when we take a look at what we've seen here is you've seen this deterioration within the emerging market space all year. It's been prolific. When you look at performance across emerging markets, specifically in the bonds, it's one of the worst performing sectors of the global fixed income marketplace year to date. It's been down roughly twice what you've seen in the U.S. markets. But also, when you look at the the developed world, what you find is that it's still expansionary. However, it doesn't seem to be as robust and as strong as we were seeing at the first quarter of this year. So again, something to keep an eye on. There's been lots of talk about a recession. I see some questions in the queue about that. I'll get to that towards the end of the presentation and talk about what we're watching here at DoubleLine. But bringing this back home to the U.S., again, very similar picture, right? If you look post-global financial crisis, GDP tend to really stay between a range. It was roughly, call it like the low 2%, 2.2 to roughly about 3% real GDP growth. Even when we had the greatest economy ever, it was about 3% back in 2018. Again, very similar picture on 2020, the degradation to the pandemic, the overshoot back to the upside. And notice now the expectations in the U.S. have been revised down more than what you've seen really from the global GDP estimates. And so what you find here is that, again, we're going back to this kind of trend line growth. At least that's what the economists are telling us at this point in the cycle. So we'll have to keep an eye out. I know there was a negative GDP print in the first quarter. The GDP Now, the Atlanta Fed's estimate of the second quarter GDP is also showing a negative reading. We'll get another update to that data point on Friday. But so far, it does look like that we're going to have a little bit of contraction in the first half of the year. One other thing I like to look at is a time series that the New York Fed puts out called the New York Weekly Economic Index. And so why I like this, unlike GDP, which is only released on a quarterly basis, and we do get those updates from the Atlanta Fed when there's new data to put into their model. But if you look at the Weekly Economic Index, it tends to correlate quite nicely to GDP on a year-over-year basis. And so you can see here that the real-time economic data that's being reported by the New York Fed shows us that we are in this kind of slowing regime as well. So it's very consistent with what the mood and the tone is out there in the economic data, that it's likely, when we get to second quarter GDP on a year-over-year basis, it's likely about to be around 2.5%. One other thing, we like to follow our leading economic indicators. The Conference Board does a good job of putting these out. These are what we call necessary but not sufficient indicators. It's necessary for them to go negative in order to have the recession, but just because it goes negative, it's not a sufficient condition to say that you are in the recession. And so when we look at these lines, we like to look at the 12-month number, the year-over-year number, but we also try to speed that up a little bit by looking at the 6-month rate of change, and that's the blue line here. And you can see here that the leading indicators on the 6-month basis are starting to print negative numbers. And so, again, this doesn't mean that it has to pull that red line down, but you can see that momentum has been pretty poor within that red line. So again, this doesn't put us on recession watch today, but it is something to kind of alert our antennae and put them up for that recession watch. Another thing, I talked about the PMI data. Again, manufacturing is a smaller piece of the U.S. economy than the service sector of the economy. And so it makes sense to look at not just manufacturing and also look at the service sector as well. So even though it's called a purchasing manufacturer index, really it's talking about the economic activity within those regions, within those sectors, whether it's goods or it's indeed services. And so looking at the manufacturing, we can see the degradation there. We also see what's happened to on the service side, but notice that these are still kind of in their average levels that we've seen post GFC. And so you can see that blue line on manufacturing has dipped negative a few times, didn't pull us into a recession. I think that both of these indicators need to be in those contractionary levels, that is sub 50, and for a period of time in order to really call on the recession. Remember, services tend to drive a fair much more part of our economy than the manufacturing segment. But again, these are diffusion indices, meaning that they're survey data, that they're just talking about your intention of expansion versus contraction, and it's done by throwing out surveys to individuals. So why do I care about this? This is kind of another a measurement of thinking about what current level of economic activity is as managers plan to do their spending. And so I think what's most important right now, it's on everyone's mind, is the inflation. We were told, 12 months ago that this was indeed transitory, the level of inflation. It has since gotten unwieldy and gotten away from bankers around the world. And that's why you've seen the pivot across central banks being extremely hawkish late in 2021 as well as in 2022. And what's very interesting about this chart, I think I pointed out last time I used this slide in a webcast, is that it's really rare for the developed market world to be generating a higher level of inflation than necessarily the emerging market space. And some of that has to do with the EM countries tend to be more commodity intensive, which has a little bit more volatility within them. But it is pretty amazing to see that the developed world is what led this new inflation regime across the globe. And for all the talk that's made about policies, potentially there was, the policies are what got us here, but this idea that it was just a U.S. phenomenon doesn't really augur well with this chart, because this chart's showing you that inflation is rampant across the globe. So when Jay Powell is out there trying to say, well, all you gotta do is hike rates, that will curtail some of the demand function, we can control the demand side of the equation. Well, the problem is that everyone is consuming very similar baskets of things that are causing these inflationary readings. So the world is exhibiting some of the highest inflation we've seen in over 40 years, and it is driven by the developed market as well. So we all have become inflation experts. I'd say even my parents ask me about the level of inflation these days. Maybe that means we've hit peak inflation, and I think we're getting very close to it on tomorrow's print. When we get there, we probably will see one of the cycle highs, absent there being another push upwards significantly in the commodity complex. But if you look, all of the measures are reading still this upward trajectory within the inflation complex. We have seen CPI, core CPI, come down a little bit. It actually is forecasted to come down a little bit on tomorrow's print. But again, these are still numbers that do not make central bankers very comfortable whatsoever. And we all know the story. It's been blamed on the supply chains. There's an index out there created by the Federal Bank of the Fed, the New York Fed, I should call it, looking at supply chain pressures. And you can see here that there has been some relief in the supply chains. We were starting to get this in the first quarter, at least, albeit off very elevated levels. But then what happened is we had the China zero COVID policy shut down, also caused more pain within the supply chain. So we are starting to see some recovery in the supply chain side, which does portend to help bring inflation down, assuming that there's the ability to deliver these amount of goods out there. And so if you break down CPI into its key components, call it goods and call it services. So think about goods are things that we consume. Services are more like the experience side of the equation, although that's not the official definition, because housing is also in services. I guess you could say living and having a shelter is an experience. I would call it kind of a necessity, but I'll digress off of that. But what you see here is that commensurate with that reversal in the supply chain bottlenecks, you've also seen a reversal in core goods inflation. So this is a very positive attribute. This has been stubbornly high. This is something that personally I thought it would reverse sooner in the complex and transfer to services a lot sooner, roughly a year ago or so. But we've seen both remain relatively elevated. And you can see here that services is starting to really start to gain its traction and move in an upward trajectory. And so the bad news about that, as I mentioned, is that services just isn't the experience. It's not just the elevated level of travel. It's not just the leisure components, where that's hotels, fuel when it comes to recreational. One of our colleagues just took a trip in an RV and was trying to make the case to me, well, it's fuel efficient. I have a diesel. And we all commented, have you seen the price of diesel? It tends to be higher than actual petrol prices. But that being said, what you find on the services side is a key component here is housing. And so if you look at rents and what they've done on a year-to-date basis, this is the month-over-month change. So you can see that once landlords had pricing power back, they took advantage of that in 2021. There is some seasonality that kind of creeps into these indices. You can see that rents tend to soften up a little bit on a month-over-month basis as you get into the fall and winter months. However, what you see is that we've resumed this increase of 1 to 1.5% in terms of rent growth. So this will continue to put pressure on what's called the owner's equivalent rent. So there's rent and owner's equivalent rent in that marketplace. The owner's equivalent rent will be tied more into the housing side. We all know the story behind housing. Housing continues to print extremely elevated levels in terms of its year-over-year price growth. We do not think this is tenable. Obviously, with mortgage rates going up, there is going to be some pressure on house prices, especially in some of these areas of the market. We do not think that this portends for a collapse in house prices. We think there's obviously certain markets that are a little bit vulnerable, but remember how much house price depreciation you've seen in the collective market over the last 24 months. And so when you compound this out, you're talking about a 35 to 45% 2-year cumulative growth rate in house prices in the major metropolitan areas. So again, this is something where even if there was a little bit of softness in these markets, prices tend to be a little stickier to the downside, but still this is going to remain elevated, which means it's going to continue to keep that pressure applied to the services component. So again, this is something that's beyond the scope and control of Jay Powell. Remember, mortgage rates aren't the only thing that dictates the price of housing. For all of America that has a 30-year fixed rate mortgage today, what you find is that they're not influenced by what's going on with the change in mortgage price. It's just if you need to transact, so it's that marginal buyer we're talking about. But also when we look at the input prices, there's something called PPI, which is a producer's price index. So think of this as more input cost into the equation. And you're starting to finally see some year-over-year decrease. That's that blue line that you see there. We also include the green bars in there. And notice still at 80 basis points, we got a decline. That's because it was such a high reading of more than 120 basis points roughly 12 months ago. So you're seeing a little bit of deterioration in this series, which is a positive thing. Year-over-year input costs coming down can also lead to having some cap on some of these inflationary behaviors. So this is a very important chart to watch as we look through it. There's another thing that we like to look at too, inside of these ISM surveys, is something called the prices paid component. And so again, this is for achieving things through your supply chains. What are you effectively paying for things? And so what you see here is that blue line is the prices paid indices. So again, it's a diffusion index. So it's again telling you how many of your respondents are saying that they're increasing the cost. So it doesn't give you the magnitude, but you can see that it correlates pretty decently to this red line. And that red line happens to be headline inflation. And here we're showing it with a 4-month lag on the data set. It just seems to, again, input costs, they have to go into the supply chain. They come out on the other side of manufacturing. You ended up getting the end of the finished goods. And all of a sudden now that leads into, if there's consumption, the CPI component. So again, we think that this augurs for a little bit more relief too on the good side of the equation when it comes to the inflation data. So good news is, Jay, there's a lot of metrics out there that are working in your favor. I don't think it's attributed to the interest rate policy we've seen thus far, but I'm sure Jay and his colleagues at the Fed would take a victory lap irrespective of how inflation comes down. So what does the bond market think, right? We all know there's elevated levels of inflation. I hear this from clients all the time. Well, we have an 8-handle inflation. Why are Treasury yields across the curve yielding roughly 3%? And that's because the market does believe, indeed, that inflation is transitory. It's just transitory on a different time frame than potentially that Jay Powell told you about originally. And so the bond market thinks over the next few years that inflation will start to gravitate towards a lower 2% range, which is the Fed's target. So you see here what we have is something called the zero coupon swaps curve, inflation swaps curve. What that does is that essentially says what makes you agnostic to between owning the tips and that's the break-even rate. But effectively, this is the way to trade inflation and make a bet on inflation. So the market is priced this in. But notice 1 month ago where inflation expectations were for 1 year versus where they are today. They have changed massively, 186 basis points. Now, fair point, a caveat there, I should say, is that there is some seasonality in inflation. And so again, that 1 month roll-up does something to do to that. But more importantly, notice across the curve, rates have come down significantly, the expectations of what the price of inflation should be. And so again, if you think about this, you could say, well, wait a second, I don't see anything gravitating down to that 2% rate. Well, what you see is that, remember, you have to compound this out. So if you think that inflation in 1 year is now going to be 4%, but over 2 years, it's going to be 3.5%, that says in year 2, inflation is roughly 3%. So the idea here is that from looking at this curve, the market thinks we're going to get back to these 2% inflation rates roughly in the next 3 or so years. Again, something we've been talking about, that inflation probably remains elevated above the 3 handle through 2024, absent some significant recession. But again, you're finding that the market is starting to gravitate this and saying a lot of this inflation behavior seems to be behind us. Again, that's the price of the market. I mentioned break-even spreads. It's another way of looking at this. Break-evens, I said this wrong on the inflation and swap side, but break-even spreads are what make you agnostic, what inflation rate makes you agnostic between owning current tips versus the on-the-run Treasury market. And notice here what you see, the 5-year break-even has diminished massively. We've had over 115 basis point rally in break-even spreads over the last 3.5 months. And so the market's starting to get some of this inflationary behavior behind it. And so I say, okay, maybe the risks are more balanced. It's not as much just an inflation, but potentially there's some deflationary risk or disinflationary risk out there as well. And when you look at real rates across the board, this is something that's very important for thinking about equity multiples, right? Equity multiples tend to be correlated highly to the direction of real rates. So when real rates are going up, multiples tend to go down and vice versa. But what you see here is that outside of Japan, real rates have continued to push up across the entire globe. And Japan is committed to a different policy than the rest of the world. This is why you've had a significant devaluation within the Japanese yen, is that essentially they're sticking to a policy that says they don't have any inflation, they're not worried about it, they're not worried about the strength of their, the deterioration of their currency, and they're not following along with the rest of central banks around the world. So there's a disconnect between those markets. And again, it's because of the differentiating policies between those central banks. Lastly, what's very important when you think about the health of the economy is employment. And one thing that you can criticize about the employment rate is that, one, it defines some people out of the workforce, which is why I include the U6. This encompasses the underemployed as well. Notice what you see here. The red line is slightly above where we were pre-pandemic levels. It's the official U3 unemployment rate. But if you look at the blue line, we're very close to where we were on the underemployment rate as well. So that takes the unemployed plus those who are not kind of punching at their full weight. And so if you look at this, what you see is that the jobs market is relatively healthy. The employment picture is robust. The downside to this is that we know that the labor market can be a lagging indicator, right? You've seen this too. We've seen quit rates be significantly high. They've been quits for the right reason, where people think they can get better employment. So continue to watch the unemployment claims, I think, as a precursor for what's going on within the employment picture. Remember, we only get the jobs data on a monthly basis. The jobs data was good enough to get the Fed to hike, and they will hike at the end of this month as well. I'll talk about that when I get in the Fed section. But what I mentioned was unemployment insurance benefits and unemployment claims. And this is a time series you get every single week. It gets reported on Thursday of every week. And when you get this data, it's usually on a 2-week lag. So it's more timely than what you see within the employment reports, or what we call the jobs report. But you can see here that those blue lines really are back to pre-pandemic levels, and there doesn't appear to be any trend except a sideways behavior. So at this stage, at least people who are being laid off or let go or quitting aren't applying for unemployment insurance. Then again, maybe those are being able to place in some of those jobs. So I didn't include the job openings data. We all know that story. There's significantly more people looking for employees than there are actually workers out there to be able to fill those out there. And so the recovery has been very sharp in this cycle. If you look at the job as diminished versus where we are today, we only have 500,000 fewer people employed than were pre-pandemic. And you could say, well, that doesn't sound like a very healthy recovery. Some of this is by choice. Remember, that's part of, if you see the decline in participation rate, especially against certain demographics within there. But if you notice in the global financial crisis, how long did it take to get back to the same number and the same level of people employed? It took roughly 4.5 years. So we're doing this now within a little over 2.5 years. And I would expect potentially, assuming we don't go into a recession, that in the next few months, let's say by Labor Day or so, by that September report, we will have a similar level of employment of where we were pre-pandemic levels. So again, this is it can be a lagging indicator, not a leading indicator. but it is very important to watch the health of this. And I see there's questions in the queue about a recession, and it's very hard for us to have a recession without a degradation in the employment picture. People need to lose jobs. The unemployment rate needs to go up, and it needs to change the income component of what's going on. So on that front, looking at the income component, wage growth continues to be extremely high relative to any point since the early 80s. And so again, this is not what's driving inflation, but I think this is a second order effect of some of the inflation that, and with a tight labor market, that people have to compete for some of these workers today. And so you see this both in the average hourly earnings as well as at the Atlanta Fed surveys as well, which encompass the people who are, it compares the same worker to where they were 1 year ago. So it adjusts for the makeshift in that labor force. So I think the most important picture right now is to watch the labor market. I know that we're seeing some conflicting data and we're seeing some slowdown in the economic data out there. But to me, as long as the employment picture is strong and that the labor market continues to have power, that we will not enter into a recession. It may be a technical definition of some contraction in GDP, but that's not how the BLS defines it. I know there's a heuristic that say 2 consecutive negative quarters is a recession, but that's actually not how the BLS defines it. So thanks, everyone. Thanks for your time today. Thank you for your support, and bye for now.